This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend Taylor from Life Goal Investments. How you doing, bud?
Let's do it. Let's do it. I'm excited.
Yeah, so episode number 3, if I had to guess, is going to be an episode where we disagree. My audience loves it when my experts disagree with me. So, Taylor, what I thought I would do is lay out what I thought the Fed was going to do, and now where I'm changing my opinion, which actually freaks me out a little bit. So I'm hoping you disagree with me, but you ready for this?
Give me your thought process. Let's do it.
So you've heard me for probably 2 months now say that I think the end of the year is going to be 75, which is November 2nd, 50, December 14th, 25 pause. That gets us to roughly 4.5. That's what I've believed for 8 weeks now.
Yep.
After the strong jobs number, after the CPI number, after core being the worst we have seen, and I think could get worse. Taylor?
You're going higher. You're going higher. I see where this is going.
75, 75, 50, 25, pause. That's like 5.25.
So would you add another 75 bips onto that then?
Yes.
On the original. Yeah.
Yeah. So I'm up 75. So I'm gone from 4.5 terminal to 5.25 terminal, which takes us to the second meeting. So we'll get 2 raises next year and then a pause. What do you think of all that?
So first and foremost, I'll give you credit. From the origination of our conversations, which goes back at least 6 months now, you were on the higher side of things. I was on the lower side of things, even than what's played out. So I was saying that the economy is going down the tubes a little, and that's a little overstated, but I said the economy is slowing dramatically. And because of that, the Fed won't have to raise rates. And you said, no, Taylor, you're wrong, because unemployment is extremely sticky and that's not going anywhere. Or employment, whichever way you want to call that. And then the other one was housing. You're like, these are the 2 biggest components that drive inflation over the long term. And you're like, they're not going away quickly. And you were like, your thing was a recession will start later. My thing was a recession will start earlier. And you said the Fed will have to raise rates high, to a more meaningful degree in order to get us to that recession. So with that background as the context, I think that you've been more right than I have. I think we did enter a recession sooner than you predicted, which was my prediction. So I guess we both kind of have our rights in that opinion, but I have to move in your direction in the way of rates having to rise, because as you stated as we both stated in the last episode, the core components aren't rolling over. And at some point, me as a disagreeer, that's my title, with you, I have to actually come around to the news. Like, you can't just stay staunch in your own opinion. So yeah. I will say this. I think you're still too aggressive. I think that they're not going to have to raise as much, but I'm absolutely moving more in your direction, because at the end of the day, when inflation has proven to be as sticky as it has, we learned in the 70s, you can't give up on inflation. When you give up on inflation, what you have is, in the 70s, we had 3 Fed chairmen. The first 2 gave up on inflation, where they raised rates and then they paused. And what happened was inflation ripped out of both ends of it. And then lastly, Volcker came in and said, I'm going to raise rates enough where this thing gets choked out. I don't care what happens. And he did. But we did learn a lesson that inflation is pervasive, it's persistent, and it's not something where you can take this half-ass approach of let me raise and then pause and raise and then pause. And that's what I thought was actually going to have to play out. But the data isn't saying that. The data is saying that inflation is more sticky than what I guess I had originally thought. And certainly I think the Fed had originally thought as well.
Yeah. The other thing I think about when I go forward, so again, I think terminal rate somewhere between 4.5 and 5.25. I think if you were giving me that range, I would take that bet. The other thing that I think about is, will they cut in 2023? And the answer I have there is I hope not, because I think the only thing that forces a cut is just something just horrific and nasty. If there's little things, I think they don't move, right? If the stock market fell 20%, if the UK pension funds did this or that, they're like, okay, we get it. The strong dollar is hurting lots of places, but we can't stop. If the Fed is forced into a cut, I think it's something really, really bad. So I hope they don't cut next year.
I guess I will disagree with that comment, because I think it's pretty clear right now, especially with bank earnings that just came out. I think it's very clear that the economy is slowing. And I think it's not pockets of the economy. I think as a whole, the economy is slowing. Now, some of the input costs are scary high, like food, like energy is starting to rear its head a little bit there again, housing on the other side. But the overall output, GDP of the economy is contracting. There's no way to look at that any differently. And I think that that bleeds through at some point into the things that are driving inflation. And so I think that if we continue on the brakes here in a massive way, I think GDP starts to contract more quickly. And then on the other end of that, you get a fall off of inflation, and then they sit on their hands and they go, oh boy, have we gone too far now? And I think that is likely to be the case, that they're going to go too far and break something. And it's already breaking, right? The recession is already setting in. If it's not, I think it has set in at this point, but if it hasn't, it's setting in. And I think that if they continue to raise, they'll hit a violent number at some point, and then it'll really break and they have to cut.
So you think a cut next year is possible, even outside of a black swan event?
Yeah, I think what you see throughout history is that it's not infrequent at all. And at one point I knew this number and I forgot it, that 6 months within the stopping of a raising of a rate cycle, that they cut. So it's not like this is something abnormal to us. This is what they do. They raise rates until they
too
break
far,
shit. And then they step back in and they cut on the other end. And I think that that's probably likely what's happening. Not yet, but in 2023.
So again, if we play that out again, we exclude the black swan, the big nasty stuff breaking. What I think you're telling me is you see a cut in the second half, probably
Yes.
a pause.
Yes.
Okay. All right.
So, and like, to frame it this way too, and I think we've discussed this on the channel in the past, but what you had last year was kind of a confluence of a couple different things coming together: stimulus checks and a booming economy from that standpoint. That's the demand side. That's the consumer. The consumer, at the end of the day, I think when we look back on this, will have driven about 2/3 of inflation. The other third of it is supply chain. So supply chain stuff is going to abate. And I know that we've been stating that this is going away quicker than it actually has. It's been stickier than it should be. But that is definitely going to be gone, at least as a big part of the excuse in 2023. So that, that is about a third of the inflationary pressure that we've experienced abating. So that's another helpful thing to push inflation down on the other side. But to your point, like, and we talked about this on one of the other videos, like, food inflation's scary right now. I can't put my finger specifically on what's driving the food inflation, because commodity prices have rolled over. The input, soy, wheat, corn, et cetera, have come down. And the only thing, and we've talked a little about this, is that, like, the delivery mechanism is fuel driven, and it's diesel fuel, which diesel fuel has been propped up in a massive way. That's a big part of the input cost. Hopefully that rolls over at some point.
Yeah. It's going to be really interesting because, again, the other thing that's going on with inflation, it's obviously reported on a yearly basis. We've gotten rid of the last kind of small number.
Right.
It's called the base effect. That will be helpful. But even with the base effect, I don't see headline getting under 6. And if you know anything about inflation, at least historically speaking, anytime inflation is over 5, you don't break it unless you get Fed funds above inflation. And we're not anywhere close to that.
Nor have we ever seen inflation above 5 controlled without a recession. So the fact that people are talking about soft landing is like, and we've been laughing at people talking about soft landing now for 6 months, literally. But you remember back in the beginning of this, like, we were talking about soft landing and we're both looking at each other going like, well, how does that work?
How does that happen?
How does that work? And inflation is getting to 9%. Like, how do we actually get this down? We've never seen it at half that 9% rate. Now, 5 is not quite half of 9, but you get the point, without causing a recession in the past.
Yeah, you've got to raise you've got to have unemployment not be 3.5. It's got to be 5.5, 6.
It's scary for people at the end of the day, and rightfully so. Like, the Fed is staring down the barrel of this and saying we need a softer labor market. And it's like, what does a softer labor market means? It means we need people to get fired. It's not a happy topic.
We need millions of people to get fired.
Yeah. What unemployment's at 3.5 right now. To get it to 4.5, that's about 1.5 million people to get fired. And it's a scary proposition, because we all know somebody that's going to be in line that winds up getting fired out of this. So it's not easy to root for, but at the end of the day, and you look at the economic backdrop, it's a necessary evil.
Yeah. So kind of ramping up this Fed. So I'm fearful that we have to go to 5.25 terminal rate. It sounds like you're below that. Do you think we get to 4.5?
Yeah, I think 4.5 is probably realistic. I even think 4.75 is not unrealistic at this point. But where I think I disagree is that I think that the writing is on the wall at that point in 2023, and I do think they have to revert back and cut on the other end, because I think they're forcing us into a recession, no doubt, And then
Yeah.
the more violent they get on the way up, the more violent it's going to be on the other end. And that's going to be more, if that plays out, that's going to be more of what you warned of 6 months ago.
Yeah. And the last thing, I don't know if you've taken a look at it. I think wasn't it the Atlanta Fed that has this GDP predictor that they update?
GDP now? Yeah. I haven't
I think
looked at it
it's-
just recently, so I'm not sure exactly where it is.
I think I checked on it last week. I think it was positive, like 1.2% for Q3.
The last time I saw it was shockingly high relative to what I thought it would be.
Yeah. So that'll be interesting, right? You get Q1, Q2 negative, and then you get a positive Q3.
What we've seen with these, though, what we've seen with that GDP now predictor, essentially that is just a quantitative driven system where it takes all the data, gets input, which is nice because it's quantitative. There's no one there screwing with it at the end of the day.
Yeah, it's
putting
no
their
opinions.
flavor on it. Exactly. I'm actually trying to drive this political agenda or whatever it is, not whatever. But at the end of the day, it's just raw data. And what you see is that I've been watching it now. It's been trending
Down.
coming from the beginning of the quarter down towards when the GDP report actually gets printed. It's trended down every single one of the last 2 quarters.
Yeah, it's going to be interesting. I'm going to go check that out after this call. So I think it's still positive.
Yeah.
So
Yeah,
we'll see.
I bet it comes down from where it is.
Yeah, the trend continues. It gets worse from here. I like it. I like it. Taylor, where can people find you?
Yeah, find us at Life Goal Investments on Instagram. We appreciate you letting us plug there.
Oh, absolutely. You guys do great stuff. You're educating people. You're giving. It's absolutely plug it. Thanks, bud.
Thanks so much.